Here is a number that should stop you cold. 3,220 tons of gold. That is how much the world's central banks bought in just 3 years, from 2022 to 2024. To put that in your head, the Statue of Liberty weighs about 225 tons. So we are talking about the equivalent of over 14 statues of Liberty in pure gold being hoarded by governments in just 3 years. And the pace is not slowing down. It is speeding up. But here is the part that nobody is talking about in the mainstream news. This gold-buying frenzy did not happen by accident. It was not just fear. It was not just instinct. It was a response to a very specific, very quiet rule change that happened inside one of the most powerful buildings most people have never heard of. A rule change that essentially rewrote what money means at the highest levels of global banking. A rule change that the big banks and the people in charge of the financial system had been debating for decades, and then quietly, almost sneakily, set into motion. That rule change completely flipped how physical gold is treated inside the global banking system. And by the time you finish watching this video, you are going to understand exactly why central banks all over the world are loading up planes with gold bars and flying them back home. You are going to understand why the London gold market in early 2025 was so overwhelmed with requests for physical gold delivery that people had to wait 4 to 8 weeks to get metal they had already paid for. And you are going to understand what all of this means for your wallet, your savings, and the future value of the paper money sitting in your bank account right now. Let's start at the very beginning. The building in Switzerland and the rules that run the world. There is a building in Basel, Switzerland that looks like it belongs in a science fiction film. It is a tall, cylinder-shaped tower, kind of strange and out of place compared to the quiet Swiss streets around it. This building is called the Bank for International Settlements, or the BIS for short. And if you have never heard of it, that is kind of the point. Think about how banks work for a second. You keep your money at your local bank. Your local bank can go to the Federal Reserve or the European Central Bank when it needs money. But where do those massive central banks go when they need guidance? Where do the people who run the global money system make their rules? The answer is the BIS. It is basically the central bank of central banks, the most powerful financial institution on the planet that almost nobody talks about at the dinner table. And here is the wild part. It operates above most government laws. It has full diplomatic immunity. Nobody can touch it. It makes the rules, and everyone else follows them. The BIS runs a committee called the Basel Committee on Banking Supervision. This group of experts writes what are called the Basel Accords, which are the rule books for how banks all over the world must behave, how much cash they need to keep on hand, what kinds of assets they are allowed to hold, how risky they can be with your deposits. Every major bank in every major country lives by these rules. After the 2008 financial crisis, when banks nearly collapsed the entire global economy because they had borrowed way too much money and held way too many worthless assets, the BIS got serious. They looked at the mess and said essentially, this can never happen again. The result was a massive updated rulebook called Basel III. Basel III divided bank assets into levels based on how safe and reliable they are. The safest, most reliable stuff is Tier 1. Think cash in a vault. Think government bonds from wealthy countries. Regulators say if you hold $1 million in Tier 1 assets, we will count every single dollar of that when we check if your bank is safe. You get full credit. No discount. The riskier stuff is lower on the ladder, Tier 2 and below, and regulators apply what they call a haircut to it. That means they say, you may have $1 billion worth of this asset on paper, but we will only count 500 million of it toward your safety requirements, because we do not fully trust it. Now here is where the story gets really interesting, and a little bit absurd. How gold got treated like a risky bet for decades. For a long time, if a bank wanted to hold physical gold in its vault, solid bars with serial numbers, real heavy metal, the banking rules treated that gold with deep suspicion. Under the old rules that had been in place for years, physical gold was stuck far down the ladder with riskier assets. Regulators applied a 50% haircut to it. That means if your bank held $1 billion worth of actual gold bars, locked safely in your vault, regulators would only let you count 500 million of that toward your required safety reserves. Half the value just disappeared on paper. You were literally being punished for holding real physical gold. Think about how strange that is. The oldest form of money on Earth, the thing that humans have used to store value for over 5,000 years, was treated by the modern banking system as roughly as trustworthy as a pile of corporate debt or a risky stock portfolio. Meanwhile, government bonds, which are basically just promises from politicians to pay you back someday, were considered perfect, zero-risk assets and given full credit. The official excuse was that gold prices move around too much. Too volatile, they said. But if you look deeper, the real reason is more uncomfortable than that. The entire modern financial system is built on paper. Paper money, paper bonds, paper promises. The people who designed that system needed banks to hold government debt, because that keeps the whole arrangement running. If banks could instead hold gold, which does not rely on any government or central bank to have value, that would be a problem for the paper system. So they quietly made gold less attractive for banks to own. And it worked. For decades, big banks had very little incentive to buy physical gold. Holding it was expensive and gave you almost no regulatory benefit. You were basically tying up $1 billion in your vault and only getting credit for half of it. But here is the twist. While the real stuff was being discouraged, the fake version of gold was thriving. The paper gold casino and why it matters. Most people think of gold as something physical, bars, coins, heavy, shiny, real. But on the trading floors of London and New York, the vast majority of gold being bought and sold every single day is not physical at all. It is paper gold. And the scale of this paper market is staggering. In London, through a trading network called the London Bullion Market Association, roughly 95% of all gold traded is what is called unallocated gold. That is, just a bank's promise to give you gold at some point if you ask for it. There is no specific bar sitting in a vault with your name on it. There is no serial number. There is just a number in a computer saying you own X amount of gold. The bank may have some physical gold somewhere, but it does not have nearly enough to cover all the paper claims. This is fractional reserve banking applied to gold. The same way a regular bank takes your deposit and loans it out to 10 other people while promising you can withdraw any time, a bullion bank in London might sell claims to 100 ounces of paper gold while actually holding only a few physical ounces in its vaults. This works fine as long as nobody actually asks for the real metal. And for decades, most people did not ask. This system actually suited the banks very well. They could trade billions of dollars worth of paper gold back and forth every day, generating fees and profit, without ever needing to move a single heavy bar anywhere. And under the old banking rules, this paper gold was treated quite generously. Banks could use it as collateral for other deals. They could trade it freely. The system hummed along. Then, in early 2025, something cracked. Gold prices had been rising sharply, and a lot of investors who held paper gold claims in London started asking for actual physical delivery. The Bank of England's vaults, which normally processed delivery requests in 2 to 3 days, suddenly had a backlog. People who had paid for gold were waiting 4 to 8 weeks to actually get it. The math was becoming very uncomfortable. Analysts estimated there were roughly 380 million ounces worth of outstanding spot contracts in London, but only about 36 million ounces of gold were actually free and available for immediate delivery. You do not need a calculator to see the problem there. This is the paper gold casino starting to show its cracks. And here is where the Basel III rule change becomes the most important part of this whole story. The rule change that changed everything. The final, most significant pieces of the Basel III rules began rolling out, with the United States implementing key provisions in July 2025. And buried inside this enormous, complex rulebook was a change to how unallocated paper gold is treated at banks. Under the new rules, if a bank wants to keep trading paper gold, the kind where there is no physical metal actually backing the claim, they now have to set aside a massive amount of their own real capital to cover it. The regulators assigned what is called an 85% required stable funding factor to unallocated gold positions. That is the same treatment they give to corn and lead. In other words, paper gold is now expensive to hold from a regulatory standpoint. Very expensive. Banks need to lock up large amounts of their own cash just to keep their paper gold positions open, which eats into their profits dramatically. But at the same time, the rules maintain that physical, allocated gold, meaning real bars in a vault with your name specifically on them, gets a 0% risk weight, just like cash. It is treated as fully safe, solid, reliable capital. What the regulators essentially did was put a massive tax on the fake stuff and reward the real stuff. They made the paper gold casino much more costly to run, while making physical gold more attractive to own than it has been in decades. It is like they finally looked at the entire system and said, the leverage in this market is dangerous, and we are going to squeeze it out before it blows up in everyone's faces. Now here is why that matters so much. For years, those massive paper gold trades kept the price of real physical gold suppressed. When too many people started buying gold and the price climbed too fast, big banks could simply create more paper gold contracts and flood the market with artificial supply to push the price back down. It was a pressure release valve for the fiat currency system. A high gold price makes paper money look weak, so there was every incentive to keep gold looking tame and boring. But if Basel III makes it prohibitively expensive for banks to run those massive paper trading operations, that pressure release valve starts to close. The artificial supply of paper gold shrinks, and the real physical price of gold has to find its true level, based on actual demand and actual supply, for the first time in a very long time. And actual demand, it turns out, is absolutely enormous. The great gold scramble happening right now. Here is the part that should make you sit up straight. While all of this regulatory machinery was grinding away in the background, the world's central banks went on the biggest gold buying spree since the Bretton Woods currency system collapsed back in the 1970s. From 2022 to 2024, central banks bought over 3,000 tons of gold. That is more than double the pace of the decade before. And in 2025, central banks added another 1,237 tons, still historically extraordinary. As of late 2025, the value of central bank gold holdings reached roughly $4.5 trillion, which actually surpassed the total value of U.S. Treasuries held by those same central banks. For the first time in modern history, central banks collectively hold more value in gold than in American government debt. Let that land for a second. The institutions that run the global financial system now trust gold more than they trust U.S. government bonds. And not just by a little. So who is doing all this buying? The leading buyers in recent years have included Poland, China, India, Turkey, and a long list of emerging market nations. Poland's central bank governor openly stated his goal of raising the country's gold holdings to 30% of its total national reserves. He flew physical bars back to Warsaw and stored them in new high-security vaults built specifically for this purpose. China officially reported over 2,280 tons in reserves by 2024. But most analysts believe the real number is significantly higher, as Beijing stopped publishing monthly updates at one point. India has been quietly adding gold for years as part of a long-term strategy to reduce dollar exposure. And then you have Russia. After Western nations froze roughly $300 billion of Russia's foreign exchange reserves following the 2022 Ukraine invasion, every country in the world that had ever disagreed with the United States took notice. If you held your national wealth in dollar-denominated assets, and someone in Washington got upset with you, they could make those assets disappear with a keystroke. That was a wake-up call heard in capitals from Beijing to Riyadh to Ankara to Warsaw. Gold cannot be frozen. It cannot be sanctioned. Nobody can press a button and take it away from you if it is sitting in your own vault. The result has been a massive, ongoing shift in how countries think about national wealth. The dollar's share of global foreign exchange reserves has dropped from about 71% in 2001 to around 56% today, the lowest in 30 years. Countries are diversifying, and gold is where much of that diversification money is going. BRICS nations, which now include Saudi Arabia, UAE, Egypt, Ethiopia, Iran, and others in addition to the original five, collectively hold over 6,000 tons of gold and are still adding more. Their share of global gold reserves jumped from about 11% in 2019 to over 17% by 2025. The geopolitical dimension here is enormous. Eastern nations, and particularly China, do not play the paper gold game. When China buys gold, they buy the physical bars, put them on planes, and fly them to vaults in Beijing or Shanghai. They want the real thing. So while Western banks are being squeezed by Basel III's new rules and slowly backing away from the leveraged paper gold casino, Eastern governments are sitting on mountains of physical metal that the new rules classify as top-tier, safe, reliable capital. It is a massive, quiet transfer of hard wealth from west to east, happening in slow motion, right in front of us. And 100 years from now, historians are going to look back at this period and shake their heads at how few people noticed while it was happening. What this means for the price of gold and your money. Gold prices have already responded to all of this. At the start of 2025, gold was around $2,644 per ounce. By mid-2025, it had surged past $3,400. By late 2025, it was trading around $4,000. That is an increase of roughly 50% in a single year, following a 27% gain the year before. And some analysts project gold reaching $5,000 per ounce by 2030 as the structural demand continues to build. But the price movement is almost secondary to the structural shift happening underneath. Here is the real story. For decades, ordinary investors were told, gold is a relic, an old-fashioned thing, not productive, pays no dividends, just sits there. The smart money, they said, was in stocks, bonds, and dollars. And yet, as that advice was being given, the people who actually run the money system were quietly hoarding the very thing they told you was outdated. In the first quarter of 2025 alone, central banks added 244 metric tons of gold to their reserves, which is 24% above the 5-year quarterly average. And according to surveys by the World Gold Council, 95% of central banks expected their gold reserves to increase over the following 12 months. Not a single central bank surveyed said they plan to reduce their gold holdings. Zero. They are not selling. They are all buying. And they have been every single year for 15 consecutive years. Now consider what is happening with the debt picture at the same time. The United States national debt crossed $37 trillion in 2025. The interest payments on that debt alone crossed $1 trillion per year, which is more than the entire U.S. defense budget. The math here is not subtle. The only realistic way out of a debt trap this large is through inflation, meaning governments quietly destroy the purchasing power of their currency to make the debt easier to repay in the future. It is a slow, hidden default that most people do not notice until their grocery bills and rent have doubled. Gold does not participate in that devaluation. Since the year 2000, the dollar has lost over 40% of its purchasing power. In that same time, gold has risen over 600%. The contrast is not a coincidence, it is math. And here is the important nuance to understand about Basel III and HQLA status, because there is real confusion about this online worth clearing up. Some sources claim gold was officially reclassified as a Tier 1 high-quality liquid asset as of July 1, 2025. The actual situation is slightly more layered. Allocated physical gold has always had a 0% risk weight under Basel rules, going back to 1988, meaning it is treated as safe as cash from a capital risk perspective. What is genuinely new and significant in Basel III is the crackdown on unallocated paper gold through the 85% funding requirement, combined with the overall tightening of rules that makes physical gold relatively much more attractive for institutions to hold. The LBMA and the World Gold Council are actively pushing regulators to formally recognize gold as a Level 1 high-quality liquid asset, a designation related to liquidity coverage rules, not capital risk rules. That full reclassification has not happened yet, but the pressure is building and the direction of travel is unmistakable. The bottom line is this: whether you look at the regulatory changes, the central bank behavior, the debt numbers, the geopolitical realignment, or the price charts, they all point in exactly the same direction. The institutions that run the global financial system are repositioning themselves around hard, physical, tangible wealth. And they are doing it quietly, while official statements from those same institutions project calm and confidence. That gap between what the big players say and what they actually do is the most important signal in this whole story. The question nobody wants to answer. So here is the uncomfortable question sitting at the center of all of this. If the people who designed the current paper money system are now quietly moving their own reserves away from paper and toward physical gold, what exactly does that tell you about how much confidence they have in the system they built? Think about what a central bank actually is. It is the institution that creates paper money. It is the entity most invested, literally and philosophically, in the idea that fiat currency works, that government bonds are safe, that the paper in your wallet is reliable and durable. These institutions have spent decades telling the public to trust the paper system. And yet they are buying gold at double the pace they bought it a decade ago. Over 1,000 tons per year, every year, for 3 years straight. Moving it into domestic vaults, building new storage facilities to hold it, refusing to hold it in vaults abroad where a foreign government might interfere. Poland literally sent a plane to pick up gold it was storing in London and brought it home. These actions speak much louder than any press conference. The Basel III rules reinforce the same message. Make it expensive to hold paper gold promises. Keep it cheap and safe to hold physical gold. Quietly steer the system toward hard assets before the leverage in the paper system gets too large and too dangerous to manage. There is also an important point about who holds the most physical gold right now. The United States still sits at the top with over 8,100 tons, followed by Germany with about 3,350 tons. But the BRICS nations collectively hold over 6,000 tons and are catching up fast. As the geopolitical balance continues to shift, the distribution of physical gold reserves will increasingly reflect and reinforce the new balance of financial power in the world. The phrase that keeps coming up among serious analysts studying this is structural price floor. Because so many central banks are now buying gold as policy, not as a trade, meaning they buy it regardless of price, and hold it for decades, there is a permanent, non-negotiable floor under the gold market. When prices dip, sovereign buyers step in and absorb the supply. That dynamic was simply not present a decade ago. And now add in the shrinking of the paper gold casino thanks to Basel III, the growing pool of institutional investors who just got regulatory permission to hold physical gold on their balance sheets without penalty, the ongoing de-dollarization, the inflation outlook, and the debt math. You have a case for higher gold prices that is structural, not speculative. It is not about fear or panic or some crisis moment. It is about the slow, grinding, undeniable shift in the fundamental rules of how the world stores value. What you can do with this information. Let's be clear. This is not financial advice, and you should always talk to a professional before making any investment decisions. But understanding what is happening at the structural level of the global financial system is genuinely important, regardless of what you decide to do with that understanding. Here is what we know for certain. For the first time in a very long time, the biggest and most powerful financial institutions on the planet are treating physical gold as a core reserve asset, not as a relic or a curiosity. Regulatory changes are actively discouraging the leveraged paper gold market while rewarding institutions for holding the real thing. Central banks bought over 3,200 tons of gold in 3 years and show no signs of stopping. The dollar's share of global reserves is at a 30-year low and still falling. And gold prices have roughly doubled in 3 years, while analysts project further gains. The message being sent by the people who actually run the money system is not subtle. They are not saying it loudly. They are not announcing it on television. But they are saying it through their actions, their rule changes, their purchases, and their vault building. They are preparing for a world where physical, tangible, hard assets matter more than paper promises. That preparation is already well underway. The question is just whether you noticed it in time. If this video changed how you think about gold and the global financial system, hit that like button right now because it genuinely helps more people find this content. And if you want to keep getting these kinds of deep dives into the financial stories that most people miss, subscribe and hit the bell so you never miss one. Now I want to hear from you. The central banks are clearly acting like they do not fully trust the paper money system they created. So here's the question I want you to answer in the comments. If the people who print the money are buying gold with that same money, should regular people be doing the same thing? Drop your thoughts below, let's talk about it. And if you want to go even deeper on where the global financial system is heading, check out our video on de-dollarization and what it means for everyday people. It connects directly with everything we covered here today.